If you're an options trader, you want to know how to roll your contracts forward in time to give yourself more opportunity to win. This video is for you, going to show you how to do that inside of Interactive Brokers TWS right here, right now. A lot of you watching this channel, watching these videos have asked for this. So here it is, plain and simple. When you have a position that's negative right now, like this one is right here on Oracle, this bull put is negative. What you are essentially wanting to do is saying, I'm okay with taking this capital loss of $10 or whatever it may be, and I'm going to roll the put forward, which means close off this position right now. And I'll show you do this in a second. You're going to close this position right here, this bull put 195, right? It's got two legs in it. And we're going to reopen the same position, but further out in time and maybe with a little bit different in the strike prices. Here's what it looks like. You want to take this capital loss and say, I'm okay with losing $10 because I want to make up more money long term. I'm going to go ahead and go right click on here. And this is how we execute this roll. Right click. Instead of buying, selling, closing, we want to go to roll, hit that little red button at the end there. And you can only do this when your position is negative, because obviously if you're positive, you don't want to roll. You want to keep that position the way it is and have it make more money for you. So when we're rolling out this position, again, we are closing off the current position that we currently own. So we sold a 100 put. So there's an order in there to buy 100 put, right, to close it off. And there's an order here to sell that 95 put that we normally bought in the first trade. Hopefully you're with me on that one. Take a second if you're not. What we're going to do then is we're going to go further out in time, because more time gives us more opportunity for the stock to move a certain way as we want to. In this case, we want it to move higher, right? So we want this to go out in time. July, we're going to go July, we're going to go August, and we're going to go August 18th here, okay? And what we want to do is exactly the same thing we did in the first place. We want to sell that same bull put contract, or create that bull put contract again. We want to go and make sure we're doing this to get a credit again and not a debit. We want to make sure we're getting paid to do this, because we're going to give it back that $10 in capital and just lose that money right now. We're going to eat that, right? It's a realized capital loss. But what we're going to do here is select strike price. Let's say 110. We're going to sell that one, and we're going to buy, let's say, the 100. So you'll notice that I picked 110, and I also extended the gap between the two strikes to 100, just so that we made sure that we had a credit coming in here. And we don't want to take a capital loss on this trade as well. We want to make sure this is a credit right here. So you want to have this negative number be negative if you're looking for a credit. We're going to go to the advanced tab, make sure we're going to get paid, margin performance right there. And this will show you what the impact is going to be on your account. You always want to see this. If you're going to roll out in time, you want to make sure you're receiving more of a credit. Like, we're going to give back that $10, right? We're going to be okay with losing $10 to potentially make this $173 in premium. That's how you roll out and give yourself more time. The only problem with this is that if the stock price moves against you too quickly or too fast, you may not be able to roll enough and may not be able to roll it out in time to actually become positive and like get more capital in this trade. It might be too far gone, where it's better just to accept the loss on the trade and not try to roll your contract out. It just depends on the situation, depends on what you're trying to do and how far it's gone in the wrong direction. But in this case, we can roll this out just about a month here and extend our expiration from about 30 days to about 60 days. And we can override transmit, and we can go ahead and put that order in the hopper. And once it goes through, it would then replace what we have here at 195 with the new terms here in this order right here, right? It's going to look the same thing, but here we have the closing of the 100 and the 95, the opening of the 110 and 100, and those would populate in your account. And we just see we have this negative 10 gone. We would have a realized capital loss up here, assuming the market was open, and then we'd have a expiration date that was updated here at the end from 39 to about 60 days. And we would then go ahead and have a different kind of average price. We'd have everything kind of beefed up, and it would be now showing this new combo, this 110, 100 bear put spread or bull put spread that we just decided to open up. So again, when you're doing this, you want to understand that you're realizing a capital loss when you're rolling your options contract. So you're losing money. But the idea is that long term, you're going to get paid more of a credit when you roll, so that it's going to offset the capital loss you take right now. If it doesn't, or if it's like break even, it may not make sense to roll your option. Maybe better just to go ahead and just eat the loss. Like, for example, on this position down here in this account, I am down big on an options call here on a meta put. I've got 4 puts. They're down about 99%. So the entire value of what I paid for those puts, thinking Meta was going to go down, is gone. And I like, this would be one where I wouldn't look to roll, because I would have to go out like a year or like a leap in time, and it wouldn't be worth it. And I would just have to accept this loss here. It's going to be almost impossible for me to roll this position out. It's something you can use like kind of as a repair strategy, when things aren't going your way initially. But if it gets to this point, 99, 80%, it depends where it's at, what the market's doing, but it's going to be very difficult and almost impossible for me to roll this position right here out in time far enough to make this capital back. And also, when I'm doing this, I'm realizing a $6,000 loss. So I would really need to bank on Meta going down after that. Otherwise, you're just digging yourself a bigger hole. It's kind of like if a trade is going against you and you're just buying shares outright. If you just keep buying and buying and buying and it keeps riding the way down, you're just making the position worse for yourself. So sometimes it's better to just take that capital loss, eat it, and don't worry about rolling. Go back and kind of live to play another day in your account and do it the kind of the old fashioned way without trying to roll or do anything kind of too fancy. So hopefully this makes sense to you guys. If it does, great. Leave a comment what strategy you like to use and what you're going to use to roll it on. If it doesn't, let me know what you don't understand, and I will make another video trying to walk through it and explain it in a little bit more detail for your specific kind of scenario, different kind of stock you're trading, different kind of positions you want to take on. Thank you so much for watching. I will catch you guys on the next one.